Clearly, gold underperformed for a while. But what actually happens is it's kind of like a spring. The longer you hold it down and the harder you hold it down, the bigger the snapback reward is coming. So people who didn't even realize the role of gold, but realize it now, are going to get back pay, not just the upside for this era, but they're going to get back pay for all the manipulation and the hold down that hasn't happened. Gold should have been linear at the rate of inflation going up. And in fact, it went down for entire decades. They succeeded in suppressing it. They succeeded in turning everybody's eye away from the most beautiful woman and say, here's a mannequin, a plastic woman, dressed up doll. And we all started cuddling and fell in love with her.
Maneco 64, home of alternative economics and contrarian views. I'm recording this interview with Francis Hunt on Friday, October 24th. It's late in the day here in London. Francis, welcome back to the channel. How are you doing?
Always happy to come back and chat with you, Mario. Very good.
Yeah, it's great to speak with you too. And before we go further, I just want to tell the viewers that Francis' channel, The Market Sniper, I highly recommend it. And he's 5,000 subscribers short of 100,000. So if you haven't subscribed yet, make sure you do. So he'll get one of these silver plaques, which I got when I got to 100,000. And the other thing I was noting about these plaques, Francis, is that the gold plaque is for when you get to a million, which I'm not really thinking about right now. But the gold silver ratio on YouTube seems to be 10-1. So that's an interesting little snippet there, I think.
Yeah, and with gold to go higher and silver to go more so, that certainly points very well for our silver stacker friends. Maybe they know something, maybe they're signaling something in all of that, Mario.
Maybe. We're gonna talk first. You want to talk about the dollar index, and so take it away, Francis.
Certainly. So it's worth on charting to take a little look. We've got to always remember there's two parts to the gold and the precious metals trade. And one of them is the dollar. And the dollar's had a very poor year by most measures. But eventually it reaches a point where maybe some people think it's done too much. And progress to the downside is either slower or it even gets some support and maybe has some grinding strength to the upside. It's important because of the significance of being 50% of the trade. What's bad for the dollar? So gold progress is not reliant on the dollar. It's a loss of faith in all fiat, but particularly and especially the hegemon. So the hegemon is very much the apex, but gold can still progress to the upside to a degree, but it's not got as strong a tailwind if the dollar itself is not weakening. But we may still see very good progress generally. We'll come back to that in a bit. But let's just have a look at where the dollar is. I've gone with a fortnightly. I can also do a month, but I like to show people a couple of key moments. We are in a trend for the Dixie. These were top outs on the channel. You'll see the gray line, and these are base outs along the red dotted line that have occurred. So a couple of things have happened recently. And I want to highlight them. You can see over here that you've not only topped out, bottomed out on that basing ascending grind line, that dashed red line over here, you've also come back to recognize a key constriction funnel point, which was over here when we actually were quite bullish the dollar and we called for the run of 112,000, which ended up being the target there. And again, in an orange box, it just overperformed to touch the other side of this macro trend channel that it's in. My overall expectation is that the dollar will eventually break down through this, but I don't think that's necessarily happening right now. We've come a long way from on the high side very, very brutally to the downside. We've got this funnel support area, which was a structural area that had tightened around before breaking to the upside. You also have the blue $100, the 100 Dixie level. It's not it's the Dixie level rather than just the plain dollar. And we're kind of going to have this squeezing between these two, the 100 being obviously a very logical round number. It's shown to be significant here. You could see the shooting star that smashed through the 100 during the CV19 events and then fell back. You can see the interactions also with the 100 as well as with the channel. A lot of interactions with the 100, a very small iceberg above it there. And then support here, for example, a little bit there, certainly there. And then you bounced when you broke it. You had a rally up to here and then you broke. And then you had a rally up towards it there with that wick. So you're being squeezed at the moment on a basing ascending grind line like that, where you're grinding along the lows of a trend channel. And you're also coming across a horizontal level that's a key level. And so this triangle that you're in for the Dixie, you got the support on the funnel and you've rejected a little bit of a hammer. So you're probably going to get some upside on the dollar. Now, is it going to be moderate upside that squeezes here and gets a technical bounce above the 100 and then bounces along and then comes along here? Or could you get something potentially a little bit more assertive to the upside that could have some zip in it? And that could push out the gold progress a little bit longer. In the long run, though, faith in fiat is dissipating and faith in the dollar specifically is dissipating, but you could maybe get a structural event that causes a short-term spike back in the range. The most unlikely for me is a breakout of the top of this trend channel. I think in the end, you're falling out the lower side. But I'm not sure it's that moment right now. And I will talk about why I think the dollar can come up a little bit against other pairs. So this has got a little bit of an FXy feel. I'll go through it quickly because I know many of the guys are precious metals fans and they maybe have less enthusiasm for the cross fiat analysis. But we, in our views, are expecting an upside move here on the yen as well. To 172. So that dovetails to a little bit of dollar strength. I'll draw the structure for you. And I think we are breaking up at the moment. So again, it's an HVF draw tool, which we've designed for drawing our particular setups. That's it over there. I'll highlight, you'll see the candle bodies here are very, very tight. You kind of got a little bit of a drift down and a little bit of a drift back up. We call that funneling. And you also had what's looks like a shooting star candle, but is not in the typical place for a shooting star, and a hammer. And when they occur one after another, we call that range definition. It often happens when it's kind of like you're walking in a dark tunnel. You hold your hand up to feel the ceiling so you don't hit your head, and you test the floor with the other hand. Price behavior does that too when it's being squeezed. So it's less of a shooting star, that candle, and less of a hammer, but more range definition. And we've given it a name because there is no existing theory for it. And we find it happens often in our funnels, and we call it kettle drumsticks. It just looks like two kettle drumsticks put at opposite directions sitting there. A test of the range to the upside that comes back down in quite a low volatility environment, and a test to the downside that comes back up. And you've subsequently broken here, and we have 172 target for that. So this points to the yen, which I've always put as a slave nation of America post-World War II. Go watch. We've done on that same YouTube channel that you were mentioning a very interesting chat with Professor Werner, who's German, lived in Japan, wrote about quantitative easing as a concept and suggested that Japan did it all those years ago, and is seen as the expert. He'll tell you that even though there was a peace agreement signed for the Japanese, they've been a slave nation at a fiscal and economic level. And I think they've got to keep the yen weak as a wholesale funding for Casino America. There's capital saturation in the Mag 7, cheap borrowing in Japan, and there's a conveyor belt running between these two nations, and it's known as the carry trade. So this is a triggering event, and this target that we're suggesting that could come is around 172 on the weakening of the Japanese currency. So people think this is all bear only the dollar. In actual fact, it's pretty bare all fiat, and the yen has in some cases been terrible too. And if we're going to get a little bit of support for the dollar, the yen currency needs to devalue. We've also spoken a lot about their interest rates that are creeping up on the long end of Japan. That used to be all fractions of percent, well sub 1%. Those have decayed immensely. So their debt is debasing. And at the same time, they're also releasing their pressure of borrowing through the currency too. So there's a debasement trade going on. We've called the Nikkei long because of the debasement of the currency, and it's making headlines on new highs, the Nikkei. But if you divide it by gold ounces, you will find that the currency effect of the Japanese yen has been almost worse than the dollar. In fact, it is. So it might be just for everybody's 360 degree understanding, a fun drive-by on other things, because people will hear about the highs on the Nikkei and the fact that this is a major turn that's taking place in many people's views. Look at this Nikkei over here, and then I will show you how you should be viewing it. Let's just switch those two draw tools off. There's our big draw, and we've called for 74,000 on this for quite a few years. The original trigger happened in the 18. Of course, we had 2019 and COVID events in there, and then it was back to going up around about this era. So this is stocks. And this is the same fallacy that all the melt up boys on stocks get caught up with. And I'm going to show you these charts, and it's going to be very stark. This looks very bullish to anybody. And this big rounded bottom, you've got your inverted head and shoulders. We've generated a target at 74,000 there. You can see this is a log scale. If I take the log scale off, you can just see what a rip this truly is. So you can see how large a calling for a 74,000 target is and how much further there still is to go. So when I delog that, I'll put it back on the log scale just to bring some proportion to everything. But if I do the following, you'll see how it certainly spoils the bull parade view. If I divide it by gold in dollar terms, that is gold ounces, and in actual fact, we could even better still do it in gold Japanese yen. I hope I've got enough history there. And you do that. That is the truth of the Nikkei chart. Isn't that totally just from another realm different in terms of what you thought was exceedingly bullish?
Sorry, Francis, to interrupt you. I've done that with the FTSE as well, and I've got the Dow, and it all looks very bearish in terms of real money or gold.
Correct. And that's why we keep coming back to the core trade. Don't let the melt up boys excite you about the NASDAQ, the MAG 7, the SPY, the DJI, the Dow Jones, or other indexes elsewhere. We've called this long ago. This is going up, but a large part of that is currency effect. And in actual terms, the assets are debasing in real terms against gold ounces, and gold ounces are your measure. I'm going to change that to XAU USD. So even if you were an American and your currency is the dollar, you get more history because the gold, you can still see this isn't a great chart. I don't want to do that one more time. It's gone and chosen Pepperstone. We've lost a bit of the history there. I want the longer history. Sorry, FXCM. And like that, there we go. Now you'll get more history to view here. This is just showing you, this is the people that, and if you go, let's go, that's a month. Let's get a bit more duration. Let's go 3 months. You know, from 1970, you are heading down in gold ounces. Yes, you had the big 80s rush. During this period, you would have done well if you were whaling into the Japanese market then. But then once it topped, it's been a long, very brutal down ride. It's had a small rally recently, and this is very much in the territory of reversal pattern. You know, the rounded top here with the hits and that, very much in the territory. So my message, without having brought a gold or a silver or a platinum chart or a minor chart up, is you have married the beauty queen. You know, I've just shown you an absolute ripper of an equity chart, and then I've shown you why it's not. Because you're not using the right basis for accounts. The key thing, Mario, is when you are in the era of hyper stagflation, which is what I believe we are experiencing, your unit of account in terms of the dollar, and if you're in Britain, the Great British Pound, of course, is no longer a valid and useful unit of account. It's an aging old monkey on a very slippery pole who's not putting in the climbing effort to actually maintain his current elevation and ends up in the crocodile pit at the bottom. So you should cease to do measurement of assets by utilizing the dollar, the pound, or the euro. They are all debasing. We are in a debt fiat debasement era, and they are synonymous, debt and fiat. You don't have debt debasement, but no, my currency is going to be fine. They are born of each other, and they will lockstep their way geometrically perfectly to the downside. So we're going to have an explosion of cost of living. We're in that convexity period. By the way, mentioning Japan, they had 100% in rice prices in about 18 months. Wasn't a couple of years or 18 months, ridiculous on a staple for Japanese diet. So they too are experiencing the fiat debasement and the CPI. So yeah, as a start off, I just thought I would take a headline of today, nick high at new highs, put a bit of perspective on it, and take the lesson that that gives and bring you back to the fact that you married the beauty queen. Stop looking over the fence at the other girls.
So before we proceed further with the interview, I just want to give a shout out to Dirty Man Safe. So with traditional safes, their so-called advantage is that criminals can't break into them. But Dirty Man Safe is different. Its advantage is that it's undetectable, so they can't even try to break into it. And that's only one of the many features of Dirty Man Safe. They provide 3 different sizes, and you can bury your gold coins, silver coins, bars, important documents, jewelry, and anything that's valuable for you. So yeah, Dirty Man Safe is affordable, convenient, provides you peace of mind, confidentiality, and sustainability. So if you want to find out more, there's a link below in the description. It will take you to a landing page, and if you use that link, you get 10% off if you were to decide to buy a Dirty Man Safe. And they ship it to Europe as well, not just the United States. Yeah, going back to the dollar index, Francis, I kind of agree with you that we could see a rally. And do you think it could be because of war breaking out maybe in Europe? That could be a reason, and capital flowing to the US from Europe. And the other thing, second point, and I'll let you reply to it. Second point is that the dollar index was created in 1973 when the Smithsonian Agreement, which fixed the fiat currencies against each other, collapsed because prior to 1971, all currencies were fixed to each other and the dollar was fixed to gold. But when Nixon took the anchor off, the gold anchor, it was impossible to keep currencies fixed because people cheat, governments print and borrow. So they created this dollar index to keep track of the dollar against the major fiat currencies. And you know what level it started at? Well, it started at 100. So we're still around that level, and gold at the time was 85. So like long term, like you said, gold might get some headwinds in the short term from a stronger dollar, but longer term, gold will go up in all fiat currencies.
100% agree with all of that. And the Dixie is not really a good measurement of all global currencies. It's got the yen in there as a westernized nation, but it's 52% the euro, which then didn't exist. It was the mix of Germany and all the others, the Deutsche Mark, the Italian lira, of course, now merged into the euro, that presided at that time. The pound, the Swiss franc, and a little bit of Swedish krona. It doesn't really have the weightings of the BRICS nations or the Grand South on any great degree. So it was very much a westernized hegemony type, which further makes my point that Japan is part of the westernized captive, even though it's far out east, complex. So those were great points that you made. The other thing you asked, what could be the driver? Could it be a warfare? So let's go to your question and deal with that. The two currencies that I see slipping immensely is the yen, which I've just covered with the USD JPY. We're also at a very, very important level against, and some people think it's a bit random to bring up this currency because it's kind of a first world currency, but it's not considered so much of a major, the South Korean won. And I see the potential that not in the not too distant future, we're going to have a Korean won crisis. We have a very large pattern on that we've been awaiting, and we've got very close to the levels for a triggering event. In fact, I'll be doing my own YouTubes on this specific point, probably either today on a live stream or in the new week. And I keep thinking, what crisis is this that weakens the won? So, the big businesses in South Korea are Kia, Hyundai, Samsung is massive. You think of devices, TVs, and they've been very strong. So again, I think South Korea becomes similar to the Japanese nation in that their index the Kospi will go up and their currency will go down. So they're going to face that debasement. But again, I will highlight that gold will be the outperformer, and in real terms, they'll be rebasing, but they'll hold a little bit better value than the currency, which will be devaluing. But we actually see a more than 50% devaluation in the not too distant future for South Korea, being a geopolitical event. So when you asked about war, you were probably thinking of escalation of Euro land, trying to be tough with Russia and other things. I want to say that the dollar gets bid during war, regardless of where it happens. And actually, it could be North Korea testing missiles. It could be, who knows, a unification decision. Doesn't sound very likely given Germany and had East and West Germany at one point. Maybe it sounds far-fetched now given the animosity, but who knows? You could have China move maybe on North Korea or maybe even on South Korea, or who knows? You could have, there's a lot of peculiar debt vulnerabilities in South Korea in terms of how their banking system, how they do rental agreements is quite peculiar. So it doesn't have to be European of nature, and any stability suddenly in an Asian nation could form real contagion that could see a bit of bid into the dollar. I still think money will go into gold in that event, but it will also potentially go in the dollar. So what you could have is a run to both that sees the dollar firm and the gold still do well against most currencies and even somewhat well against the dollar.
So this is the dollar versus the Korean won, which, to be honest, I don't follow that closely. But the dollar is going from just above 1,000 4 years ago, and we're right now at almost 1,500. So the trend seems to be higher. The other thing I just wanted to show you, Francis, is the Japan inflation rate, which we've heard for years that the danger in Japan is deflation, but for the last almost 4 years, Mrs. Watanabe's savings has been heavily debased. I mean, and so it seems like 3% CPI, or inflation as they call it, is the new norm. We had today US CPI, and it came out at 3% instead of 3.1, and the market cheered.
Yeah, it's ridiculous. And by the way, these inflation measures that government run should be treated like the propaganda news that you get from the news feeds of each respective nations. So in other words, they are grossly understating. From everything that I've heard from people that live there, and the time frame was certainly 2 years or less for that doubling in the rice price. There's no way you get to the upper twos and sub threes with individual items doing that are so staple to the nation. So where is all the disinflation coming in the other product goods? The peculiarities about stats are unheralded. And I mean, just as a cranky side story, I was watching a guy who's fascinated about shark attacks, and he says they get grossly underreported. So, if divers go missing, with a bite out of their bodies, they go, well, the guy had a safety issue and died, and then a predator bit him as a dead corpse. Even when they're bodyboarding and they have a bite out of the board, they don't mark it as a shark attack. It's almost like it's agenderized like that. And then they find the body with a bite. It's no, well, he got lost and drowned, and then he was chewed on afterwards. So there's sometimes agendas, and very specifically in nations, the agenda is to mask the tax, because inflation is a tax. It's a tax on all of citizenry, and they want to give the impression that it's all sustainably under control, which is why the central banker mantra that they all repeat ad nauseum is little inflation good in a controlled way with an up curve. What they mean to say is they want to compound tax you in a manner that you don't notice, or like boiling a frog. Deflation very bad. What that deflation actually means is your currency starts buying you more things than it used to. And how's that bad for a citizen? It's only bad for a banker that is overspending and proliferating, and their debt is not devaluing, which they want, which keeps giving them further runway to borrow more and steal more and overspend on their pet policies. But, that's a bit of politics. If you'll allow me to share my Korean chart, I'll give you the big macro that you might not have seen. Because we do the macro, we're very macro technical. We build big views on long time frames. This is the technical structure on the USD Korean won, by the way. And this is what happened once before. This takes you quite some time back. But this is in the 80s, and this brought you into the Asian crisis. And the one thing about this currency is when it goes no bid, it really, really runs. It's potentially quite a thin FX, even for a first world nation. So you see these huge spikes. This was the subprime crisis. This didn't work at all well for the Koreans. Even on that crisis, which isn't the largest, they went from 900 to 1600. Imagine that happening to you, Mario, in pounds. It's worse than a Black Monday George Soros event in terms of devaluation for the Koreans. And more recently, this squeeze is now set up, and it's getting very close to our triggering level. It did a little trigger and pullback as part and parcel of it. And we see well through 2740 and through the 3000 level, which when you take that, it's at 1439, is a more than halving. And by the way, this target over here that we generated was chronically overperformed. The target was here. And this was all overperformance as a result of this. So you get wild swings in this currency when it happens. So yeah, we feel that there's something brewing there and that it's not too far away if you trigger this line. And it's quite typical. We have 5 stages to a breakout that we talk about. You do what's called the break and feign, which is exactly what's happened. It's stage number 1. Then you break and you run to our first interim, which is here. Sometimes you can get a return move to the funnel. After you've done that, it's open territory until you do, and that's where you make your money. The second interim, which we've got at about 2,100, and then you finish to target with some degree of overperformance, which we think will run 3,000. So that's the typical 5 stages, the melt up or the capitulation of the currency. That's where you make your money. And we think you're at the second phase already of this, but because it's on a quarterly time frame, it's slow motion that people are not noticing. This is a really important level, this 1445. And you're at 1439 at the moment. It's very, very close, and it's drifting upwards. So it's super weak. By the way, that should have a very strong effect, like on the Nikkei for the Kospi, but in gold ounces, again, it will point to rebasement. So that's kind of a counter possibility to your European, which you're also right. There's so much wrong about Europe that could bring a war or a conflict. We're not saying that isn't the case. We're just saying the whole world seems well set for fiat-based crises that will take the attention off the dollar for a while and make people think a dollar is a semi-safe haven, but gold will still be performing strongly against all fiat during that period. And then when the dollar has its soft spot again, it will rip again.
Yeah, interesting. That chart of the Korean won, the triangle that's been forming since the beginning of the century, even looks like a bigger fractal of the little one from the 90s. And I remember the Asian crisis that spread like wildfire. So it could be not just Korea, South Korea. It could spill over into the other Thailand and other countries like Indonesia, Malaysia, uh, and back to Japan and the inflation. You were talking about how it's a tax. There's a rule of 72. It's really easy for the viewers. So if the CPI runs at 2%, you take 72 divided by 2, you get 36. That will mean that the CPI will double in 36 years. So that means your currency halves in 36. But if we go to 3%, that it's 24 years. And I don't like to give credit to central banks, but back in the 19th century, under the gold standard, and you can look at this in the Bank of England inflation calculator, I looked the period from after the Napoleonic Wars to World War One, the CPI averaged minus 0.1 per annum. So it didn't matter that they had well, it was no inflation because it was sound money, and
Yeah.
still we had the Industrial Revolution, a lot of growth. So this thing that we need inflation is only because we have a fiat debt-based system, and if you don't keep inflating it, it collapses.
Correct. Yeah, it's a taxing system that benefits insiders at the expense of the larger mass of outsiders as well. By design, it's designed to be that way. That's why they want it. And like you say, the gold coins. I mean, how awful must it be year in, year out for 5, 10 years, paying the same price for an item that everybody knows the price? I think it's awesome as a consumer, but those that seek to control us don't like that. They like to remove all basis of comparison to muddy up the waters so that they can pass these indirect taxes on to us. And that's what we're dealing with right now.
Francis, do you want to move to the U.S. Treasury market? You recently, well, you did a live stream and you also wrote something on the literature that you send your subscribers about how a little tiny island in the Caribbean is actually at the heart of the U.S. Treasury Ponzi scheme.
It's quite incredible. I mean, the Cayman Islands, which is what we're talking about, Mario, and this is, I'll just show the diagram for the geography because it's kind of fun because it's such a speck of a nation. It has a GDP of just over 7 billion at 2023. So it might have gone up slightly, especially given that we're talking dollars and the dollar is debased. But this is our Substack where we did that article, by the way. If you register for our free mini series, you'll get included in that. We never sell your email or push any marketing on it. But that's the diagram of the Cayman Islands right there. That dot in between Jamaica, and I mean, Jamaica dwarfs it, Cuba dwarfs it, and it's just outside. If this is the Gulf of Mexico, that now seems to
Oh,
be
sorry.
renamed
Yeah, Gulf of America.
Gulf of America. Yes, I was about to say renamed, recently renamed. I mean, this literally is a speck. If you blink, you'll miss it in terms of this eye view. Has, as I say, 7.13 billion as per 2023 number. And the key number I brought is how rational and proportionate does this appear to you? Imagine I'm a guy on 250,000 a year per annum. I'm an American. And if I were to have the holdings that the Cayman has, so the GDP of the country is the income, the 7.13 billion is my 250 grand. In terms of treasury holdings, you would need to have, for the same proportion, they have 1.8 trillion in treasuries. You would need to have, as a 250 grand a year American who probably has credit cards and car finance and home finance and a lot of other things, you'd need to have a bond portfolio of the size of 68 million to have the same proportionality as the Cayman Islands holdings of treasuries. So its GDP, call it its income for the year, and I actually think GDP is quite a crappy measure and overinflates because a lot of that's consumption and a lot of nations overconsume to their income, but let's say the GDP is income, you would need, it's the equivalent of someone on 250 grand having a 68 million bond alone portfolio of US treasuries. So that's what that little spec is. And as I've already mentioned, Japan, unfortunately, the United Kingdom, where you are, Mario, are pretty much tied to this Anglo-Saxon American Ponzi support mechanism, which is why there is not the Bank of England announcing huge purchases of gold. It's China, it's Russia, it's India, it's a lot of other nations for which the wealth is being transferred to that are doing it. Sound money is not being pursued. Britain is one of the biggest holders of American debt to try keep them up. And this little island that just so happens to be off the Gulf of America, newly branded, is also this massive giant. And it has retired Goldman Sachs execs who play golf and run hedge funds camping out there in the storm alley of the Caribbean. And they've just come out and said, oh, yeah, it seems we thought we had X amount of your treasuries. In fact, it's 4 times that amount. So the Fed has only just realized that they have this whale investor. They were already disproportionately large and in the top 6 or 7, but they've now graduated even further up the pecking order in terms of this. And a lot of it's got to do with the basis trade, and this is someone else's explanation. But if you want to hear sketchy, Mario, this is sketchy. Buy the bond with instant financing. That means that 68 million portfolio that you on 250 grand had, you never had the money for buying the 68 million in the first place. You got instant financing. The hedge fund buys treasury bonds, let's say for 100K as cash as part of the trade, but they don't pay the full price up front. Their prime broker, which are the primary dealers, Goldman Sachs, Bank of America, etc., JP Morgan, arranges immediate financing through the repo market for you to buy something that you've only put a good faith deposit of 1% on. So they don't own that 68 million. They leverage to 100 to 1 in many instances in that purchase. Then the fund puts up a small amount of their own money, 1%. That's what you're putting up. Step 2, you borrow via the repo market and you temporarily sell the bond, posting it as collateral to a lender like a bank or money market fund for cash. So those that think their money's safe in the money markets, let me just warn you, you have no idea what level of Ponzi is being built up in the liquidity of the money markets for getting yield. After a 2% buffer called a haircut, that's just to allow for possible moves overnight in the futures market, agreed to buy it back the next day for 99K plus a tiny interest for the repo market. So at 5% on the SOFR, which is the new interest rate, that's about $13 a day on your 98K. Remember, they're not buying 98K, they're buying millions of this. So this is all explained in a small way. Use the borrowed cash and cover the gap. The 99K from the repo funds, most of the bond purchases, and then you fund the 2K covers, the haircut gap, and then you repeat and you lever up. So you keep pledging it as collateral and you buy further and more, and you get to this point where you have, although you've not clearly paid for, you've got massive loans, a 68 million bond portfolio. And you are on, as a nation, you're on the equivalent of 250 grand. So it's a very complex, very leveraged Ponzi-onomics that just smells like, it smells like Michael Saylor territory on micro strategy in terms of its opaqueness, its ability to understand, and the extremity of access to insane leverage.
Yeah, Francis, you also, the basis trade, you buy the cash bond, but you also, with the
Sell the
proceeds,
future.
you sell the futures as well.
Yeah.
And you take, you make the basis when the futures matures, you make the little tiny profit that is supposed to
The higher price on the
be
future
higher
eventually
than the
meeting.
interest. Yeah,
Yeah.
yeah. So it's not really a very profitable trade. The reason why they do it is because they can borrow so much and do so much. It's almost like I don't know if you know the Charles Ponzi story, The way he built his Ponzi scheme was that he found a discrepancy between the price of stamps in Europe and in the US. And so he had the same idea. I'm going to buy 10 million Spanish stamps in Spain and sell them in the US and make a little profit. Of course, you couldn't do that because it was physically impossible, but that's how he sold it to his investors. This seems very much like a Ponzi scheme. And you were comparing it to like let's say if I was doing this, if I was on 250,000 and had a 68 million bond portfolio, I mean, if someone said that to me, that someone was doing that, I'd say, well, he's probably laundering money for someone else. And this is what it seems to be.
Yeah, very, very good guess. And it would bring you into exactly this opaqueness. Of course, Cayman, which has unique tax features and where there's probably what would probably classify as light touch financial regulation, for which many awkward questions about how the hell are you paying for that? Who's lending you the money? And et cetera, are not being made, because any form of taxation, the only way it's kind of, hey, I've got a really bad way to make a small amount of money. Okay, never mind that it's a garbage business. We'll just throw such a ton of leverage at it that will blow up that minute little margin that you're making to such a degree that actually it turns into a moderately meaningful basis. But the thing is, even in Ponzi scheme, there was a real arbitrage that existed. There was a difference in price. There isn't here. You're assuming in every case that the futures market is going to return, that the natural contango in futures markets that sees further out delivery have higher prices is going to return. You actually only need one crisis where it goes the other way, even to a small degree. And because of the scale of the leverage, you're going to have wholesale hedge funds go bust, and you're going to have the primary dealers sitting with these trillions that allegedly were bought on financing that they arranged that these hedge funds could never have paid for. Just like it's quite clear the 250 grand a year guy didn't pay for the 68 million in bonds. He's just been consistently levered up. And it reminds me of Japan, because we were talking about the yen and the Nikkei and the roaring 80s, very much how property was pledged as collateral, given a huge valuation, 10, 100 times more. Then they would buy more, bring the new property in and get an additional 100x on the valuation of what they paid on it and pledge that as collateral and get given even more money. And so they would continue to do this. And of course, the unwinding of that bubble meant their stock market went down for the better part of 3 decades, and their banks were functioning zombies that needed debasement in debt. And Japan has been what California is to America in terms of quantitative easing and all of that. There are quite some differences between Japan and America. Japan's not a hegemon. The local population held the other side of the trade. America relies on foreign investors to hold it, and has even manufactured proxies such as the Cayman Islands. And the main reason I bring all these arguments and highlight all of this is to counter. There's a lot of influencers that say there's a shortage of treasuries, or they also make other statements like there's a massive demand for dollar and dollar denominated assets. I'm thinking of 2 people specifically in mind here, but there's
a milkshake crowd.
That's correct.
Well, I guess it's the Cayman Island Teachers Fund that's buying 1.8 trillion.
That's right. that behemoth that needs a 1.8 trillion to be able to pay out a few grannies for their lunch money. So you can see, and you must draw your own conclusions from this. Is this manufactured Ponziism, or does it look all good here, nothing to see? If you're in the all good here, nothing to see, then I'm just a moany, whingy guy who asks awkward questions, and you should muddle on and support the dollar and the dollar fiat-based system. If you see any signs of potential a conflict of interests or ne'er-do-well deeds working with primary dealers that seem to be giving a lot of leverage for people to buy assets that are not really desirable, which JP Morgan himself, Jamie Dimon, goes out and says, well, you should be looking at $10,000 gold and lots of other things, and there's a fiat and debt debasement crisis, while his same very bank is the issuer and primary dealer for the government bond market and is probably has a department that's facilitating incredible leverage for the likes of the Cayman Islands to actually buy. So, make of that what you will. To me, it smells.
Yeah. So when Francis talks about primary dealers, they're the institutions that trade deal for the Federal Reserve Bank of New York. So yeah.
They are given special license.
Yeah, and I bet the Fed is there to support them as well. So the reason Francis brought this up, I think the Cayman Island Ponzi is because it creates artificial demand for treasuries. 1.8 trillion is a lot. So if this basis trade wasn't occurring, I would say a huge proportion of that 1.8 trillion wouldn't be there.
Correct. And wouldn't have been purchased. And then think about Luxembourg in a similar vein, Belgium, and then the city of London as well. And then recently we had both UK and France-related debt issues that were being discussed, and they suddenly became the two largest for the most recent month buyers of American debt. So you've got debt problems at home. You've levered too much. You can't meet your credit card bills. You've got some cash flow. You go and buy the other end as an asset of somebody else who's more bankrupt than you.
It doesn't make any sense. Why would they do that, Francis?
Exactly, especially when gold is running and the smart nations in the East are all stacking gold, and they look ever smarter because they've been doing it for a decade and a half, 2 decades, possibly 3 if you're China. And you keep filling a balance sheet. And then I will also point out, you have the known example of a microcosm that is Tether, which many people think is this 5D chess, amazing scheme of how we'll conjure up this massive black hole desiring US debt. You have Tether, actually, that got released by the SEC from continually being prosecuted, partly because it was a Democrat, non-crypto friendly time, partly because they were getting around the dollar hegemony. They suddenly started buying treasuries for debt on an accelerated basis and committed and doubled down in 2020. Then they got left alone by the SEC, and now they need to do a capital raise. They, on the one hand, are being bragged about as the most profitable business issuing stable coins, and I think they're going to have a lot of corporate fascist companies, think Facebook and others and BlackRock, that will eventually do like a CBDC, but a private stablecoin release, especially if they will be buyers of treasuries. But what's happened is they needed to do a capital raise. Why do you need to do a capital raise if you're one of the most profitable businesses? Well, they were keeping the returns on the treasuries for themselves. That's what made it so profitable. People who buy Tether and crypto don't get paid any interest, but the collateral they've pledged were being paid at 5-6%, and they were keeping all of this, and this wasn't even their money. It's kind of, Mario, you make an absolute obscene deposit into a bank and I get your interest. I mean, that's a great deal. Of course, it's a profitable business. But if you start buying ever less credit-worthy debt, think Argentine debt, for an example, as I sprawl my narrative a little bit all over the world, and you start buying those, you get an even higher interest, and you get even more profits on pesos and all that you convert. You could go Venezuelan and Zimbabwean if you wanted. But what is actually happening to that asset? It is debasing and falling through the fall ever quicker, which is why Tether now talks about wanting to buy gold and silver miners, because they've grown a black hole in their budget, and they could do with buying something that's actually going up in dollar terms in value to plug the huge hole that all their investment into T-bills have done while they whipped all the cream of the interest rate that they never paid to the USDT holders. So you actually have a microcosm in Tether showing you how it's going to go for America, how it goes with their Argentine deals, with this Cayman deal. The valuation of the asset itself, the fact that it is yielding, is absolutely immaterial if its capital value is debasing far faster than it's paying you anything in terms of yield. And we're in the epoch, and it's a key message that I'll keep making. You go through investment epochs. I keep dealing, there's Henrik Zeberg, there's Brent Johnson, there's George Gammon. They'll all compare markets and they say, well, and there was that Scottish guy, I forget his name, Hugh Henry, saying, listen, if you'd invested since the Great Depression, so he conveniently took the Great Depression low of 1933 and said, listen, if you did active capital investment instead of buying your shiny rock, all of this kind of tone, you would be up X amount from the lows of the Great Depression. Well, what you've done is you've just spanned the financialization of everything from a relative low after a major crash, which also was a gold high, and you've compounded a financialization of everything era that has now come to an end. When the debt market got overhung and turned technically for the first time, finally we met it, and that goes with our call of September 2020, the first downturn. This is the technical break to the downside. You entered a new epoch for trading. Don't compare cross epochs. It's like me saying, it's raining outside. I'll wear my galoshes, a rain hat, some Wellingtons. That's a great piece of kit. That's the right kit. That's what gold is now in rainy season. It doesn't mean you run a marathon through a desert in it and it's going to win. You invest for the epoch you're in. We're in fiat and debt debasement times. The most valuable asset, I would say gold is valuable generally, but that doesn't mean you want to be overweighted during a financialization of everything period when leverage is being extended and asset bubbles are being inflated. And you have a suppressionist cartel that's trying to mask that fact. Clearly, gold underperformed for a while. But what actually happens is it's kind of like a spring. The longer you hold it down and the harder you hold it down, the bigger the snapback reward is coming. So people who didn't even realize the role of gold, but realize it now, are going to get back pay, not just the upside for this era, but they're going to get back pay for all the manipulation and the hold down that hasn't happened. Gold should have been linear at the rate of inflation going up. And in fact, it went down for entire decades. They succeeded in suppressing it. They succeeded in turning everybody's eye away from the most beautiful woman and say, here's a mannequin, a plastic woman, dressed up doll. And we all started cuddling and fell in love with her. And then suddenly we go, but my God, she's not real. It was vaporware we were sold. This is paper mache. And now we turn back and we say, there's that beautiful woman all over again. And we're suddenly rushing back. So this is where we're at. And you're going to get back pay now for the fact that it's been artificially suppressed. You're going to get the emotional swings of a gross overreach in the opposite direction. So the fact that you never understood this till now doesn't matter, because they succeeded in taking away the growth it should have done on a clear linear basis. So, I mean, what more can I say? I don't think there's anyone who sounds more bullish than me in the long term on all of this.
Yeah, I guess that's a great analogy there. I guess silver is gold's younger sister.
Agreed.
Yeah, and Francis, just before we wrap up, one comment on Tether. Did you know they've never had an independent audit?
It's always these things. Fort Knox, Tether, all of them.
Yeah.
Hey, something doesn't happen for a reason.
And the worst thing is that Cantor Fitzgerald, which is the firm of the Secretary of Commerce, Howard Lutnick,
Yeah.
they are a major, well, Tether is a major client for them. So it doesn't seem to matter to Cantor Fitzgerald that Tether is like a dodgy, seems like a dodgy operation in the Bahamas. And I guess for the New York Fed, it doesn't matter either because it creates a demand for their Ponzi, right?
Yes, I mean Howard Lutnick is a very interesting person. He actually wasn't in the 9/11 building when his entire business was largely supposedly detonated in the controlled demolition that was 9/11. And you know these guys all move in the same circles, like Larry Silverstein, who got paid out twice. So we can go into some deep weeds there. I'll spare your audience that, but it's worth a look. But yeah, very interesting character with very interesting ties to a very interesting business, which is why I don't trust any of it.
Yeah.
Look,
Oh,
we're
did
in
you
a
know as
faith
well?
we're in a faith and trust crisis.
Yeah, he was
Why not
also,
do things? If you have it, why not prove it? You know, you'll win big by showing integrity in a time of deception. So the reason they won't audit or they don't give you public information is because there's nothing good to see there, which means you should be inherently suspicious of it. If someone has a clean bill of health, you go out there, you get the doctor's certificate and you deliver it. This is all suspicious, Mario, and you shouldn't deal with any of it. Tether, the lot of it.
yeah, and just one final thing. Howard Lutnick was Jeffrey Epstein's neighbor for like 20 years. Anyway, it was great speaking with you, Francis, and I want to thank you for coming on the channel and giving us your knowledge and wisdom. And hopefully we'll talk again. And I wish you a great weekend.
Yeah, we look forward to getting over the 100,000 marks as many of your loyal followers decide to give us a subscribe as well.
Yeah,
The Market Sniper YouTube channel. We look forward to seeing you there. And if you wish to engage, there is a link for that as well to book a call. Thanks for having me on, Mario.
you're welcome.